Can you increase rent 15% in one go? The answer is yes. And we're going to talk about this in this week's reaction video. And other topics we'll be covering, because it's going to be a lightning round, is we're going to talk about how many new listings have come up in the first week of September, which I would say is the first week of the fall market. Then we're going to talk about how $1 trillion just got wiped out in net worth for Canadians. And we got Aussie talking about the stress test. I told you it's a lot of one. And then you got Mr. Trudeau coming out with here with billions of cost-saving relief funds for inflation. And then we're going to talk a little bit about the economy, of how tons of jobs are being lost and how the US inflation is ripping still. So a lot of this thing is happening right now. There's been way too many things in the news cycle. So I'm going to jam pack everything for you in a lightning round of where things are right now, because I've been saying for a while. The first 2 weeks of September and how we end off September is going to be a very good indicator of where the market is going to be. So if you're looking for some help in how to navigate this market in this crazy fall market right now, you could book a call with me using the link that's on the screen. It's right here. It's www.chatwithzen.com.
Simply click on the date and a time that works best for you. And then when you see the prompt, fill in your name, email, mobile phone number, and the question you have for me, and then we'll chat then.
Good day, Toronto. Welcome to another episode of Prime Properties TV. My name is Zhen, and I run a Remax in the Greater Toronto area, on top of making crazy lightning round headlines like this on this video for you. So let's jump right into it, because we're going to fly through a lot of articles. There's way too much stuff to talk about. First one, residents of newly built Toronto buildings are outraged over a massive rent increase, according to BlogTO. I love how a lot of people always sensationalize things, and they took someone's kind of like rent increase. Effectively, it's like 13%. If they were to do month over month. So is this legal? The answer is yes. I've talked about this many times before. Like, you have the tenant side you got to look for, and you got the landlord side to look for. So I'm going to talk about the tenant side first. So on the tenant side front, if you are renting in a building that was built after November 15, 2018, I'm going to put it right here, November 15, 2018, you're not under rent control. So if you know you're going to be living at a place for a long time, you should probably consider a place that was built after November 15, 2018, so that your rent increases are what the Ontario guideline is. So for 2022, it's 1.2%. For 2023, it's 2.5%. If you're built after November 15, 2018, it's infinity. So there you go. Now, on the landlord side, when we've always working with a lot of our investor clients, we've always told them, look, just pay the extra 5-10% premium so that you have the ability to increase the rents as much as you can going forward. Now, are there some jerk landlords? Absolutely. But is this a better investment for a lot of our landlords? Absolutely, because you're not restricted by the rent control rules. So the unfortunate thing is, if anyone who kind of got a pandemic relief rent, maybe they shaved $200-300 off, and you're in a non-rent control building, they're going to increase it back to market. But if you got that and you're in a non-rent control building, then you're going to stay there, right? And that's why you stay there for a long time. I have a tenant that's had a place in one bedroom for like $1,500 for a very long time. Can't increase the rent, right? They're just staying there. Next article, well, not article, but listings. I talked about, I'm going to give you guys an update on where listings are right now. And for the first week effective today, which is Thursday, it is abysmally low, right? So you can see over here in this chart, I've highlighted every September, we generally get about, call it 15,000, 19,000, and 13,000 new listings. So right now we're at 4,200 new listings. And if we keep up this pace, we're going to have 10,000. That's very low. That's very, very low. So you know how I was talking about, are we going to get more buyers or more sellers? I can tell you right now, we are having more buyers than we are sellers in this market. Now, I think we're still going to get that burst on Thursday, and maybe some stuff trickle in next week as well. But we'd have to have a really, really big burst. We're talking like a few thousand listings to even get back up to the norm. And I don't think we're going to get there. And the crazy thing is, some of the areas I'm keeping an eye on right now, a lot of these listings, I'd say like 40% of them are actually relist from people not getting their price in the spring. So that means the number of new listings that are actually haven't been on the market, call it for at least like 2-3 years, is not many. And there's a lot of bad product out there, because the people who are looking right now, the buyers, they are end users looking for turnkey picturesque properties, not the ones that require a little bit of work or like, you know, there's a lot of problems with them. So that's what I'm seeing right now in the market. And again, I'll report back next week as well. All right, next article we got here. Canadian household wealth falls by nearly $1 trillion as real estate financial markets pummeled. Lovely, lovely title. Love it. But here's my whole thing. I'm not even going to get into the article for you. Did you really lose the money if you never had it to begin with? It's a great clickbait headline, but I don't think anyone is out $1 trillion collectively as Canadians right now. It's just that the values of assets are really high, and we've always talked about this, right? This is real estate and stocks. When rates are low, assets are high, right? And now that rates are higher, assets are coming back down in price. So unless you capitalize and you sold in the spring market, call it for real estate or even stocks, there's no money that you would have lost or gained. It's just paper wealth, and that's the misconception a lot of people have. So if you read this and you think the world's burning, nah, it's just a bunch of clickbait. I would ignore it. All right, so we got the next one. OSFI, the Office of Superintendent of Financial Institution. Nailed it. They are basically getting bombarded by TREB, the real estate board, to loosen the stress test. The idea here is that the stress test is no longer required because the 5.25 cap, we're always going over it now because all mortgages are contract rate plus 2, which is over 5.25%. So if they do remove the stress test, obviously it's going to ignite the market. This is a fiscal policy that we talked about. And it's great that OSFI is saying, no, we're not removing it because they still want to protect the Canadians. Now, there's many ways you can tackle this, right? I personally think this is good because we want really strong underwriting because we don't want a bunch of bad mortgages to go out there so that people can't make payments on them. And then we have a cascading effect of like stuff blowing up like we saw in 2008. So that's a great thing about Canadians mortgages and the banking system is that it's super, super safe and super, super regulated to the extent that like getting a mortgage, if you ever tried, like you have to give every single document. So it's a really good thing that underwriting is tight, and I'd rather they keep it this way. But obviously, I'm sure people plead to help other people, loosen the stress test to get in the market, right? Now, this is the type of content you enjoy, this kind of flash lightning style. Make sure you give me a thumbs up and subscribe to the Prime Property channel. And if you're looking for some help to navigate this real estate market in the fall right now, you can book a strategy call with me using the link right here. It's www.chatwithzen.com. All right, we got next one. Our Prime Minister, Mr. Trudeau, announces billions in cost of living relief, says it won't fuel inflation. I don't even know where to start on this one. Okay. So they're giving out $500 as a one-time payment to people who are renting and low income. Great. It's good to help them. It's not going to make a difference when rents are up 25%. So if you're up $2,000 a month and now you're call it $2,200, that's going to cover what, 2.5 months? Nothing. What it's going to do is it's going to drive inflation. It'll basically end up in landlords' pockets or small business owners. That's what it's going to do. Then they have this thing with dental, and they're also giving GST rebate. And my whole thing is you can't fight inflation by giving out more free money because the bottom line is that money gets spent and it's going to drive up the demand for whatever it is that people have to buy. So this idea of it won't fuel inflation, it's like trying to put out a fire by squirting kind of like gasoline on it. No. No comment. Next article. We got Canada lost 40,000 jobs in August 3rd, monthly decline. So you kind of break through a lot of these headlines and you look at the chart. In the last 3 months, we've lost the most amount of jobs ever since the great financial crisis in 2008. So you got to remember, this is important because it's where rates are going to be. So the central banks have two mandates, right? They got maximum job employment, fighting inflation. Now that I said this for a long time, jobs are coming down, they have pressure to drop rates. But at the same time, inflation is still very high. Here we go. Here's that contradiction we've been talking about, right? Like we always said, job indicators are lagging, and now that we're seeing them, yeah, it's going to be weird times in the next 2 months. And then we got the last one here, which is U.S. inflation slowed to 8.3% in August amid lower gas prices. So here's kind of what's happening right now. I've always said this before, but here's a quick recap. Canada follows U.S. because U.S. is basically the head honcho when it comes to central banks. Their inflation is down like 0.2%. However, the core inflation, similar to Canada, meaning the cost of gas and food, has gone up, which means that there's pricing pressure on those products. You could call this, supply chain kind of issue, or you can call it in such a way that, inflation isn't coming down. But either way, when we look at this, inflation is going up or it's not coming down fast enough, which means there is pressure for rates to go up following US. And they have an announcement next week. And so Canada will have to follow US. And I've been saying, just expect 50 bips on October 26 from Bank of Canada. But when you mix this in with the fact that jobs are being lost, the central banks have a really hard decision. And that's what I'm saying. No one can predict what's going to happen with rates and where the real estate market's going to go. And I've been saying, best case scenario is that we stabilize, maybe a little seasonal uptick, but no one knows where we're going to be in 2023. Anyways, that is a wrap for you guys. Hopefully you kind of have a bird's eye view of all the things that are happening right now because yeah, the market's active. It's really active right now, but there's not much good stuff out there. So it's kind of wild. So make sure you stay tuned to these next few videos to see what's going on in the market. And if you are looking for some help on navigating the real estate market right now, you can book a call with me using the link right here. It's www.chatwithzen.com. Until next time, your move, your future. See ya. Now that you're done watching this one, how about this one? Oh, you know what? This one's good too. Ooh, this one's really good. You know what? Just watch them both.